This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Brad King from Armitage Private, thanks very much for coming on Talk Your Book. I thought you could start by telling us a bit about Armitage Private and what you guys look to invest in.
Yep, sure. Thanks for having me, Chris. Armitage is an income fund, effectively, so looking at creating a high-touch personalised service for high-net-worth super funds, effectively for clients, and also managed funds for retail clients. So as a group, we run about 300 million funds under management, predominantly in Aussie equities.
And what stock do you want to talk about today?
Today we're going to talk about Kogan because I think it's one of the more polarising and perhaps one of the least understood equities in the Australian stock market.
So I remember looking at Kogan IPO, was that probably a few years ago now?
Yep.
And mostly selling TVs and other goods, and since then it really transformed themselves into a marketplace and B, a business that sells a lot of services. Maybe let's start with marketplace and What's their growth been like there, and how does that factor in importance-wise to the business?
Yeah, I think the marketplace is more of a transition stage at the moment. So you're going from what was traditionally third-party brands, so selling other people's brands like an LG, a Sharp or whoever on their site, but using Kogan's effectively capital as to buy the stock and then warehouse it, keep the inventory. Whereas now it's a bit more of a capital light model. So you're effectively taking that product straight from the distributor to the client and taking a margin. So improves cash flow, improves capital availability for the group.
And margin on average for those marketplace sales, what does that look like?
Yeah, well, it's one thing you need to get to a bit of scale first, but from a gross margin perspective, we should be seeing, to start it out, around about the 20, but we should see that accelerate, I think, into the sort of 30 points longer term.
And what do you look like the margins for selling third-party goods?
So third-party existing goods would be around about that 30 level now. So, but you've got a lot more costs in terms of transitioning and onboarding people to marketplace, And as that sort of gets significant scale and the costs of admin of signing new clients on, because there's a lot of security issues from cyber security attacks, making sure they can deliver the products, getting the supply chain sorted. Once they sort of wash through and they get scale, you should see those margins increase significantly.
So talk us through that lag with, you've got a third-party business that you're selling their goods and then you want to onboard them in marketplace. What's the sort of time frame and lag? And you touched on some of the things that have to transpire. What's the sort of lag that takes place for that to happen, and does the market fully understand that?
I don't think the market fully understands it. It's quite significant in terms of security checks and profiles. So I think the bigger the customer should be easier, but then the bigger the customer, sometimes to get it through their risk and compliance committees and the like takes some time. So it's not something you can probably put a finite number on. But I think the key from what management have told us is that it's 50% quicker than what they were first signing customers on it. So as long as we see that incremental improvement, I think that's really the key. And
walk us through some of the Kogan services that they've branded up that they're now selling.
Yeah, I think the most successful one that people probably don't realise is Kogan Mobile, which is a partnership with Vodafone. So the frustrating thing for that, it had a really good set of growth numbers for the first 12 months, but the TPG and Vodafone merger slowed things down in terms of types of contracts that they could actually sell. So TPG and now with Vodafone, assuming it doesn't get appealed, there's $1 billion worth of spectrum that Vodafone and Kogan can effectively use now to sell their services. So that might be increased data packages at a cheaper rate. So it means that the group is more price competitive versus its peers.
And they've got from insurance to loans to super.
Yep.
Is the model really to white label offerings from other brands and piggyback on the strength of the Kogan brand?
Yeah, definitely. I think because the traditional TV business was high capital, high inventory, a lot of these newer type services effectively are just services with realistically 100% margin, because especially when you're reselling a Vodafone, your really only cost is the distribution email out, and also effectively just a bit of marketing cost to promote it. But the key ones that have been quite successful have been Kogan Energy and the Kogan credit card as well. So they're showing similar trajectory to what Kogan Mobile did in its early days, so hopefully that continues.
And is there a risk when you look at a business like this? You hear some CEOs talk about wanting to be famous for something.
Yep.
If you try and spread yourself too thin, you can lose that brand equity that you're trying to build. How do you analyse that idea when you look at Kogan?
Yeah, I think that's part of the reason they have been a little bit tarnished sometimes in the share price in the market, because they are very, well, Ruslan's his own person, I suppose, is a good way to describe it. But he's very smart, very sharp, very focused once you get to know him. So we're very confident with management can execute. They run basically an employee light position, so not too many staff, which is great, and they're getting really good returns on them. So that obviously does create some key risk for personnel, but they're still major shareholders, even though they have sold down. And hopefully, as the company evolves, that dividend profile comes through, and hopefully that should pay them a nice little after-tax earner.
And I guess being such a capex light business model, when they do start up a new horizontal, it's an asymmetric risk profile, isn't it? Because if it's costing you almost nothing, you know, the cost of an EDM and a few other costs, but if your costs are so light, if it doesn't work out, you haven't risked a huge amount of capital. And if it does work out, obviously it's a boon for the shareholders.
Absolutely. I think the only risk from that perspective is overloading the consumer with opportunities. So they've just got to try and find a right balance. You know, not every customer is going to have car insurance, energy, credit cards and superannuation with Kogan, but they can obviously track. I think they're one of the best companies at tracking users' behaviour, and you can only see that. You should sign up for their newsletter, and if your email's on there and you click on a TV, they'll incrementally drop the price. So they're very sharp and savvy as an e-commerce business.
And they've got their loyalty program now, which I guess plays into that customer loyalty and the value proposition they create.
Yeah, so Kogan First is their loyalty program. They're priced at $99, so a little bit more than the Amazon Primes, but the whole point is to create a higher value proposition for the customer. So they want you to pay more, but they want to give you more benefits as you increase your spend per annum. So the good thing is now they've gone from 100,000 products to nearly 1 million, and hopefully their share of wallet increases. So whether you buy your Kogan TV or your Finish dishwashing tablets, you're starting to look at what is value on that website and creating a basket of goods rather than maybe just buying one or two things here and there.
It's hard to talk about online sales without talking about Amazon at some level and what effect they'll have. Well, they're already in Australia, but when they start to focus on growing their Australian business even more.
Yep.
How does that make you feel? Is there nervous for more than one dominant player in the Aussie online retail space?
Yeah, I think the first point is that it probably impacts the traditional bricks and mortar guys before it impacts Kogan. It absolutely has an impact on Kogan. There's no question about that. But the key that Kogan has is they've got some great warehouses. They know the Australian market. They've been operating it for a long time. And also just having that 1.7 million active customers, which they basically purchased 1 million off the Dick Smith, basically going into receivership. That was probably one of the smartest moves they've ever done. It just gives them such greater reach and potential to upsize the total value of the client order. The other thing is they also sell their own exclusive brands through Amazon as well. So being able to distribute their own products through Amazon gives them a bit of if Amazon gets greater market penetration, they'll get some sales on that too. So it's not perfect, but it does give them a bit of a backup plan, I suppose, if Amazon do really well. The other thing is Amazon's logistics. It is quite a difficult country to move things around. So I think Kogan's expertise in that will put them in good stead.
Depending on who you believe, it's forecast that our online sales in Australia are going to grow around 15% over the next few years, which is a huge tailwind when you look at what other industries are going through. When you look at a business like Kogan, is it a case of even if they maintain market share, and in all likelihood they'll probably grow it, they've got a really big tailwind at their back for the next few years? Yeah,
absolutely. I think as people get more comfortable with shipping goods to their house and as the logistics channel evolves into more business to consumer effectively rather than business to consumer, you're going to get greater efficiencies in that. And people feel more comfortable now putting their credit card details over through these sites and things like that. So as you get your GenWise, your Afterpays, these type of services, that electronic payments channel really just works in Kogan's favour.
And we still lag UK and China for online shopping. Do you think there's an ability for Australia to catch up, or do you think there's some structural differences between those countries and Australia that will mean we never quite reach the levels that those countries have?
Yeah, I think some structural and some other quirks as well. We're quite an outdoors bunch of people, I suppose. So I think not being inside as much of Asia or Europe or US during those sort of winter periods. I'm from Ballarat. It's cold, but it's not that cold. So that quirk and also just the ability to move stuff around the country. Now, I suppose we're fortunate that we have a lot of our population between Brisbane to Melbourne. So it is quite a tight band, but obviously there's logistical nightmares of going to Perth or different time zones across the country as well. And you're shipping heavy goods, bulk goods, a long way.
Now, I haven't mentioned or read about coronavirus in the last 20 minutes. So I'm starting to get withdrawal symptoms.
Yep.
How do you feel coronavirus will affect Kogan's supply chain? And are you expecting any impact to be, sort of V-shaped, if you like, or do you think there's going to be some longer lasting impacts on Kogan?
I think definitely it'll be V-shaped. Now, I don't think it'll be a perfect V. It probably takes a little bit longer to get back towards the top. With the whole supply chain, the good thing about technology is it's a rapid supply chain. You don't hold a lot of inventory because the pace of technology means that you can't afford to have something that gets outdated and you can't sell it. So the good thing about that is when those channels open up, the manufacturing process and the new technology that comes through will be quickly replaced. And that's often a good thing for Kogan because as these people hold inventory, older types of inventory, like an LG or whoever, they can get it to Kogan, sell it at a discount, and Kogan can get it out to the consumer at a nice and affordable price.
And I guess none of the services are really going to be impacted. Well, they'll still have some impact, but not as much as the actual hard capital goods.
Yeah, I think it will be impacted, but it's just as much of an opportunity, right? So as people get a little bit more concerned, they're probably a little bit more cost conscious and might go towards a Kogan rather than maybe a JB Hi-Fi or a Harvey Norman or a David Jones or something. So they do have a few tailwinds in their favour.
Now, I only have a few hard and fast rules in investing. Don't invest in a CEO that wears a pocket square.
Okay.
Don't invest in a CEO that refers to himself in the third person. And as soon as directors are selling shares, dump as quickly as you can.
Yep.
Ruslan Kogan sold $21 million worth of shares in August.
Yep.
And David Schaefer, the CFO, I think sold about $8 million.
Yep.
How have you been able to get comfortable with those sales?
Yeah, I think just having a very open dialogue with the company. I mean, obviously they're not going to tell you their plans exactly, but from where the company's growing, we have I think it has a really good runway. Yes, they've taken some money off the table, but they didn't sell a lot into the float, so that was a positive. And yeah, obviously they want to spend some of their money that they've put a lot of time and effort into it, so I don't have a problem with it. The dividend now is quite favourable, so hopefully that'll keep their pockets nice and full in the first time. I'll have a couple of rules too, so just like you.
Beautiful, Brad. Really appreciate you coming on. Looks like a really interesting opportunity, and thanks for being a part of the show.
Great, thank you. Thanks, Chris. Thanks for having me. Cheers.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.